Yeah. In fact, I'm going to start with the debt reduction question. Ramesh Kalyanaraman joining us, Executive Director at Kalyan Jewellers. Ramesh, thank you so much for your time. We always enjoy our conversations here at NDTV Profit. Let me start with a request for an elaboration on the pause on debt reduction.
Yeah, so debt, we have been reducing debt over the last 1.5 years. And once we decided that, now we are at a level of more than 500 crore debt reduction. The only objective of debt reduction was to take out certain land parcels which were which was non-core for the business, which was mortgage in banks as a collateral. So if we are able to take out these collaterals and liquidate it, we can make the balance sheet lighter. That was the only objective. And we have been consistently doing that. So now we have started the paperwork with banks to take out 200 crore worth collateral from the banks. So as a company, we decided we will just take a pause, let the collateral come out, and then again start repaying. So that we don't repay and then wait for if in case the collateral does not come back. So we don't want to go into that situation. So we just took a pause. Maybe in the couple of months when the bank brings out the collateral, we'll again start repaying the debt. So it's a pause and it's not a full stop.
No, that's for sure. It's a pause, not a full stop. But considering that you're not lowering your capex plan, so in that sense, does it really make sense for a pause in debt reduction? Maybe that is something that the street is trying to understand right now.
Yeah. So again, we have two new projects which are ongoing. Okay. One is we are opening our third line in the jewelry segment, which will predominantly focus on regional, which will compete only regional brands. That we are going to do at least 5 showrooms in the next 12 months, which will need maybe 300 crore capex, including inventory, and post which the expansion will be in the FOCO model. And we might even convert the 300 crore which we employed and bring it back to the system. That is the plan number one. Plan number two, which we already implemented pilot over the last 4-5 months, is we worked on certain vendors with a leaner credit period, and we saw whether the margin growth is substantial, the margin growth is satisfactory to the capital employed there. We saw that it is worth trying it because the return on capital for the amount employed for this pilot project was more than our ROCEs at a corporate level in India. So we might continue with that. We might try to add more into it also. So these are the new two strategies which the brand has.
What about this lean credit procurement? I think you mentioned it briefly just now, but if you can just go into a bit of detail of what is this lean credit procurement and how will it actually work?
So as a company, we enjoy a credit period of around 30 to 32 days on an average, wherein the lean credit period will be 1/3 of it. And the negotiation with the vendor is in such a way that we get better margins when we do that, and which is actually capital accretive. So we wanted to try that. And the new regional brand which we are launching, from day one, we will do it in that procurement pattern.
Ramesh, good morning. Are your key stakeholders on board with this pause in debt? I'm trying to think about what's happened from the last time that we spoke until now, right? Your growth numbers look okay, business looks okay. The stock is getting punished. One of the only anomaly that I see in all of the things that has happened is that from the earlier guided path of serious debt reduction, you've made a pause there. So are your key stakeholders on board with this strategy of pausing at the current point of time as opposed to sticking to the glide path of debt reduction?
So again, when we tell about a new strategy, it will take some time for our investors to go through it properly and understand what we are trying to do. Once the strategy is right and once the communication is right, I don't think we do something which is bad for the company. It is only about the time the investors will take to absorb the new strategy, the time for us to communicate to the investors about our new strategy. And we have done our own working, and we feel that it is capital accretive. And again, debt, let me clarify, it is not a full stop, it is just a pause.
Ramesh, just so that in the interest of time, I'm not saying you have not done the checks. I'm sure you have, which is why you would have done this. But just wondering if you know, that, you know, I think that the notes that are coming in are saying that the street is worried that you are investing on back end and will go for higher in-house manufacturing, which is concerning on the ROC metric for investors.
That's also,
How would you say to that? What would you say to that?
Yeah. That's why I told you there is a communication gap wherein the communication might not have reached properly.
Would you use this? Would you use this interview to address that, Ramesh?
Yeah. So we don't plan to enter manufacturing in the near term. The only strategy which we have done is for the leaner credit period, which is really capital accretive, which is the capital accretive is meaning the capital invested for this pilot gives us more ROCE than our corporate ROCE in India. That is the only immediate plan. And we don't have any plans to enter into manufacturing in the near future. So maybe we were trying to communicate one more thing wherein we have a land allocated by the Kerala government for a jewelry park. That is not manufacturing. That is only a infrastructure which we will provide to our existing contract manufacturers who are willing to only work for us so that they can sit under a better infrastructure. We don't invest in machinery. We don't invest in anything else. It is only a shell infrastructure which we will have to create, which is not too much of capex. So in the immediate near term, we don't have any intention to enter into manufacturing. The only intention is for lean credit, which is very capital accretive.
Got it. So Ramesh, let's lay it out. What is your current ROC, let's say end FY25, right? And if you do all of this, what is your end ROC, let's say FY26 or FY27? Any thoughts there?
Yeah, so now the corporate ROCE for India is around 18 to 18.5%. Okay. That's our corporate ROCE, which is further increasing every year because of the asset light expansion which is going on. Okay. That will further increase organically. Now this lean credit period again comes with better ROCE in our pilot project. And the pilot project can be stretched for the whole company whenever it is a good time. It can be done in portions, it can be done fully. The plan is not clear. And it is more accretive than the ROCE, which I mentioned 18.5 in the pilot project.
So what do you see ROCE coming to, Ramesh, and where do you see margins then going between everything that you're trying to do together, between the pausing of the debt, between the lean credit model that you're looking at? What is your target for your margins?
And just that, sorry Ramesh, just what Tamanna asked, because I asked the same thing. It could be ROC accretive, but are you giving a guidance for the ROC for FY26 and 27? Exactly what Tamanna asked.
Again, it is only a pilot which we have done.
No, which is fine. Ramesh, sorry. Please appreciate what I'm trying to ask, right? Or what we are trying to ask. We understand the rationale that you've given. Is there a guidance that you're giving for the ROC for FY26 and 27?
So guidance with the pilot project we have never given.
Overall, console ROC.
Console itself, it is already growing in the range of 1 to 2% every year. So that will continue to grow.
Okay. And the guidance and the margins guidance that we talked about, 7%, do you see this going up?
It should ideally, because our gross margins have gone up at a store level.
Yeah.
And there is some operating leverage is also kicking in. So it should be in this range is what we feel.
Okay, should stay in this range, focus on regional branches as well. Thank you so much, Ramesh, for speaking with us.